Alright guys, today I would like to talk to you about the 4 wealth building pillars of real estate. Hang on, I can't talk about something like this without fitting the part. That's better, I can't talk about something like this without being excited. So today we're going to talk about the 4 wealth building pillars of real estate, and that is cash flow, depreciation, appreciation, and amortization. These are the 4 reasons that I prefer real estate investing over any other form of investment. And this is ultimately what drew me to real estate over some of the other things like stocks and mutual funds. Don't get me wrong, all of those have their place and diversification is a useful technique. However, today I want to explain to you why I chose real estate as the main focal point of my investment portfolio. Doing the intro dance. Alright guys, so the first one that I'm going to talk about is cash flow. And cash is king, everybody knows it. So cash flow is the way that I prefer to invest in real estate. Cash flow is the amount of money at the end of every month that I get to keep after all the expenses are paid on my real estate. So if I make $1,000 a month in rent and I only pay $900 for all my expenses, every single month I get paid $100 for owning that property. Now we can all agree that getting paid $100 a month to own a property is great. And if we were to stop right there, you would probably agree that that's not a bad reason to invest in real estate. But wait, there's more. If you invest for cash flow and you buy a property at $200,000 and it earns you $200 a month in cash flow, what happens if the market tanks and your property goes from being worth $200,000 to $100,000? Nothing, because you've got somebody as a tenant on an annual lease, and they will continue to pay you the same amount of monthly rent that they were before. In fact, a lot of times when the housing market crashes, rental prices go up because people can't afford their house. And if you foreclose on a house and you no longer have a house, you need a place to live. So when the market tanks, rentals actually become more profitable because more people need them. And the law of supply and demand says, as with anything in business, that if there's this much of an item and you need this much, you can charge more to those people looking for houses. If 10 people need a house and there's only 9 houses available, those 9 who want the house bad enough are going to spend a little extra to move into your place. The other benefit to this is that when you are earning that cash flow through the downturn and nothing changes and all your people sell, when it comes back up, you still own the asset. You really never lost any money. For this reason, cash flow is a great way to weather any market in real estate. Number 2 is depreciation. Depreciation is just one aspect of all the tax benefits that come in with real estate, but it's probably my favorite. Depreciation is basically saying that because your house is going to get older, and the government understands that because it's an investment property, you're going to get a tax break every year that your house gets older. So for commercial real estate, you can depreciate your house over 39 years. But for residential rentals, like 1 to 4 units, it's 27 and a half years. That means that over the course of 27 and a half years, your property will go from the purchase price to $0 in value. Now that doesn't sound like a good thing, but if you think about it, on a $100,000 home, that's roughly $3,500. I didn't do the math, but it's around $3,500 every year that you get to write off as a tax deduction. So if your property earns $3,500 in income, then your entire income off that property does not get taxed for that year. So in essence, you're getting paid for your property getting older because you're not paying taxes. The other benefit to depreciation is that when you finally sell your house, capital gains is done on whatever value of your property is left after depreciation. So if you have a $100,000 house and you own it outright and you were going to have to pay taxes on $100,000 in capital gains, it'd be like 30% depending on your tax bracket. That'd be a big loss. However, if it is depreciated all the way to 0, meaning over 27 and a half years, you don't have to pay taxes. So if it's halfway done, then you only have to pay taxes on half of the amount that you're getting into capital gains. The government has done a very good job of incentivizing taxes for real estate investors, and I'll go more into detail on why this is, But the main thing you need to understand is that the government wants rentals so people have places to live, so they incentivize people who provide rentals because that's the best way to get people to do it. Number 3 is appreciation. Now, this is not a reason to buy a property. This is a benefit. This is, if you're lucky, this is a bonus. Don't make the mistake of buying in hopes of appreciation. If you buy for appreciation, it's like gambling. You don't know what the market's going to be like in 5 years. So why would you buy a $100,000 house, make no money on it, maybe even lose money on it, and hope that it's worth $150,000 when you sell it? Now, I understand that there's a lot of market analysis. You know, the markets go like this. And if you're smart, you might be able to buy here and sell here and buy here and sell here. And that's great, and that's a bonus. But don't ever make appreciation your main goal for investing. However, if you invest for cash flow and you use depreciation and amortization, which we'll talk about in a minute, then appreciation is a huge bonus. Because if you've been making money all this time and then you get all this appreciation at the end, it's just a bonus. And you can wrap that into your next property and then kaboom, bajillionaire. But remember, appreciation is wonderful. However, don't invest for appreciation. Another way to look at appreciation, though, is forced appreciation. Now, I'm okay with investing for forced appreciation. Forced appreciation would be when I buy a house that's only worth $50,000 right now because it needs a bunch of work. But I know that if I put 20 grand into it, it'll be worth $100,000. So what I did is I bought it here, put this much work into it, and now it's worth $100,000. Forced appreciation is actually why I prefer commercial real estate, because you can buy it here, and if you increase the rents by $20 over a couple years, now it's worth this. And you didn't do anything but up the rents. There are a ton of strategies to force appreciation in commercial real estate, and they can make you a lot of money. Be smart about it, but forcing appreciation is a great force multiplier in your investment portfolio. Amortization is number 4. Amortization is simply loan paydown. So when you get a loan, your mortgage company amortizes it, which means that you're paying more interest up front than you are principal on your loan, because that's how the bank makes money. But in our situation, amortization, i.e. loan paydown, is great, because if you invest for cash flow and you're earning that $100 a month, or more, there's a lot more that can be earned, that means every single month your tenants are also paying your mortgage. So for example, on my 10 unit right now, every single month, $700 and some change gets paid down in the principal on my loan. I still receive a decent amount of cash flow from that apartment, but they're also paying $700 a month down on the loan. That's $8,400 a year that I'm building in equity on my apartment, and I'm not paying for that. So even if I broke 100% even on my rental property, I would still be building equity via the tenant's payments. But let's say for my apartment, I'm making $800 a month in cash flow, which I'm probably making a little bit more than that. And then I'm depreciating it over 39 years. So every year, some of the apartment's income is not taxed. Now, add in that I've already forced appreciation on the property by $20,000 just by increasing rents. And then I'm going to get $8,400 a year in equity on top of that. So at the end of 3 years, when I go to refinance my property, just the loan paydown will be like $25,000 worth of equity that I've built, and that's enough to refinance. Then you factor in cash flow, depreciation, and appreciation, and all of a sudden, I owe less on the property than I originally paid for, and I've got a better rate, and I still own the asset. Factoring in amortization is a wonderful way to help build your portfolio, because every single month your tenants are paying you to owe less on your property. That would be like owning a car that your buddy pays you to borrow and he pays the loan off. It's pretty awesome. Alright guys, thanks for tuning in. These are the 4 wealth building pillars of real estate. I hope that you understand through this some of the reasons that real estate can be so awesome to invest in. Literally getting paid to own a property that somebody else is paying off for me while I'm getting a tax credit, you just can't go wrong. And if the real estate market comes crashing down tomorrow, I still have 100% occupancy, I'm still making the same amount of rent, and I can probably make some phone calls and get a break on my insurance payment or my trash payment and get a reduction because the rest of the market will have settled. I'll be making the same amount with less of a bottom line. So while you're out there investing and having fun, just remember that real estate, you pay less taxes, you can force appreciation, you can make cash flow whether the market's up or down passively, and you can write it off as a tax credit. If you can think of a better reason to invest in real estate, let me know. I want to hear about it. Also, if you like this video, and only if you like this video, go ahead and click the like button, subscribe, and follow our channel so that we can learn what you guys want to know more about and help provide it for you.